Okay, welcome back to the Scottish Property Podcast for a second time. Brian Gilmour from Indigo Square. Thanks very much for joining us.
That's okay. I'll be signing my fee in the post now. You just reminded me it's the second time.
Fees going up. Your agent's been contacted. We've negotiated.
Yeah.
So we've got Stephen Clark here, as always, as well, for the market update.
I'm here to listen, mate. Yeah.
So we do this every month, Brian, and we do the market update for the month of May, is what we're talking about today. This is where I pull out all the top news stories that happened over the month, and we get a property expert like yourself in to give us some opinion and talk about the news. So I'll just move forward with our first article. It's about the launch of 100% mortgages by Skipton Building Society. So, what comes to mind straight away when we mention 100% mortgages?
It's the 2008 crash. Exactly. And that's I suppose that's why this made so much news, this article by them.
It's like we never learn our lesson, eh? We forget quite quickly.
We do, and we're really, really smart, and the last generation, they were silly. They didn't get it. We're the smart generation who can do it better than the last generation. That, as you get older, you realise that's what happens over time.
And I was thinking about this, and that was my initial thoughts as well. I was like, here we go again. But, if you think about it from a renter's point of view, if you are renting a property and you're, at the moment, obviously Scotland, we've got the rent cap and it's only going 3%, but if you were to have to move property, you would see that rents are just going through the roof everywhere in Glasgow and all over Scotland. So, if these mortgages are specifically designed towards people who have, tenants, the actual title of them is a mortgage for renters. So obviously there's certain criteria that people have to meet. One of them is you need to be a renter for the last 12 months and have a track record of paying your rent on time. And they're going to ask for, statements showing that. Obviously your credit needs to be good. So there's a number of different, criteria that the lender Skipton's come up with to obviously make sure that they're not putting themselves out there too risky. But ultimately, it is 100% mortgage, and they don't need to put deposits down. So what happens if property prices go down? You have negative equity.
It's not a slippery slope. I'm pretty sure Northern Rock in 2007 didn't just introduce 120% mortgages. It probably started with something similar.
Yeah, I mean, it is interesting that they've not done it. It's not geographically available throughout the whole of the UK. Right. It's London in the southeast and Scotland is where they're looking at. So it's areas that they perceive that there's a particular issue with rents, and it is a dilemma. Your point there about 2008, it's a slippery slope, say that one easily, down to 120% mortgages, and as you say, if property values fall. Equally, you're looking at the challenge of people getting onto the property ladder. So I always use London because that's where most decisions are made and driven by. The average first-time buyer price in London's £440,000, right? So if you are looking to pay £440,000 and even need just a 10% deposit and a 90% mortgage, there you are with legal fees, etc. You're needing 50 grand. So how do you get the 50 grand when average rents in London are up at £4,000-5,000-6,000? So you can see people are saying, like, how do we tackle the challenge of renters who can't, they're spending all their money on rent. The average first-time buyer in Scotland, I think, is 31. Yeah. So people who are needing to get into the property market are out there renting places. The rents are high, so they can't save the money. So how do they get onto the property ladder? So you can understand people trying to come up with ways, and obviously the Skipton's thought process behind it to try and deal with the 2008 challenge is to say, but we're being really, really restrictive here. We're only focusing on a specific group of people who can demonstrate for the last 12 months that they have paid their rent on time. There's a very good chance that our mortgage product will be cheaper than their rent.
Yeah.
And maybe that's one of the reasons why they're looking at only geographical areas of this London and the southeast and Scotland, because particularly you mentioned about the rents in Glasgow and Edinburgh, and particularly in our main cities of Glasgow, Edinburgh, Dundee, those are really suffering from high rents. The rents will be higher than the mortgage, so they are maybe taking the value judgment of if someone can afford £800-900 a month in a rent, the mortgage product will probably be £200 less than that on the same type of property. So there is a bit of leeway there for them to be able to afford it. provided they can demonstrate 12 months where they've been okay paying the rent.
I mean, I think in general terms it's a good thing, you know, like if I was to find myself renting again, then I'd be like, well, I'd be all up for this, obviously, you know, because...
But they're not, I don't understand the need and to push people into home ownership. What's wrong with renters?
Well, this is where it becomes a whole idol. You know, this is stemmed for generations in the UK as, you know, to be successful, you know, this whole aspiration of owning your own home and all this, that's really ingrained in our society. So that's a whole generation.
I agree that they're putting in, you know, these criteria to not let it slip through the net. But the first-time buyer who's entering from the rental market into a property market isn't looking at it from a property price index or where the market is going. They're going, you know, I'm buying a £200,000 property and I'm getting £100,000. They've got all the risk. So yes, the mortgage might be less than their rental income, but what happens if we come into a crash in the next 6 months and the property prices drop 20% and the person that they partner with to get their mortgage or whatever, they lose their job, they're in a financial predicament because they're now in the negative equity you spoke about. So
and they can't move. So this is the issue. If you don't need to move, then maybe, you know, negative equity is not such a bad thing. You can maybe ride it out. Yeah. But if your job relocates or you need to find yourself in a position that you need to sell or move, then you're in. You're up shit.
And you're right as well. It's really interesting because Scotland has had a flip of culture from 1979. Is the line in the sand where the culture flipped from we were a nation of renters. We were people who lived in rented accommodation, and it was accepted that there was no stigma attached to social renting. There was no stigma attached to rented accommodation in general. Then we've flipped over to that culture of if you don't own your home, you're not fully participating in society.
That was like Margaret Thatcher, right to buy, basically.
Yeah, so we flipped that culture over to that aspect, and then
we're struggling to flip it back.
Well, and it leads into a whole load of other things that I'm sure we're going to go on to talk about. The deal with the challenge of we've not been building enough social and affordable housing in Scotland for at least the last 20 years. And every housing issue that we've currently got, whether it's house prices, whether it's private sector rents, whether it's public sector rental availability of it, there's 160,000 people on affordable housing waiting lists in Scotland. Everything stems back to we haven't built enough affordable social housing for at least 20 years in a country where I'll trot out one of my favourite stats, in a country which is 96% empty. 2% of Scotland is urban, 2% of Scotland is urban green, parks, golf courses, etc. 96. We could double the amount of space everybody's got in their house. Yeah. And we'd still have more than 90% of Scotland empty. And so we got the ability to build more housing in terms of space. And so that feeds into every other housing issue that we've got.
Makes sense.
And just to go over a quick few of the criteria is that you need to be 21 or over, you need to be a first-time buyer. You can actually borrow up to £600,000, but obviously that'll depend on your income and affordability. You can get 35-year mortgage term. It can't be a new build. That's quite interesting. And you obviously need to meet all the affordability stuff as well. But how do you think this could affect landlords? Because obviously it's aimed at, our tenants, so our good tenants that have, do you think we could be losing a few good tenants because of this?
Well, I'm not so sure. I think it's more of a gimmick than a reality. I think most people who have a serious consideration for house purchasing are more likely to have some sort of prudence about their decision making, and highly likely that they will be wanting to save the deposit for all the things we just talked about the risk of negative equity. So I think this is more like a headline grabber than a policy that's going to...
It's interesting to see how many other lenders come into the market. And like you say, it's not like 2008 where you could literally walk into Northern Rock and say, give me all the money to buy the house, plus another 20 grand to do a refurb.
To clear off my credit cards and my debt and my store cards.
New sofas and all the rest of it. So they are protecting themselves to an extent. And obviously all the measures that have been put in place since then for responsible lending and all that, there is a lot that's happened since.
Yeah, there is, but like you say, it depends on which lender then follows suits and offers less criteria to jump through, and then they've all got to try and follow suit to keep up with. Is there a place we can find out in the future who took these products on, like how many of these products were taken on?
Well, I don't know if they will reveal.
I think the best indicator will be, one, if competitors come into the market in the same place, and two, whether they maintain that product or whether they drop it. That would probably be the best indicator.
So moving on to our next story, Purplebricks, obviously that well-known brands of the estate agents have actually been sold for £1. So that's just really interesting when you look back at their share price going back maybe 5 years or something like that. Purplebricks were actually valued at 1.4 billion at the height of its success, and they've now sold out for £1 to, I think it's a company called Strike, which I'm not familiar with, but I think they're started up online estate agency down in England. But that just shows you how badly wrong things can go. I think the founders actually did all right, because I think they sold out quite a good time, and then.
Yeah, I think it's a bit like a lot of the dot-com firms, and obviously there was a dot-com bubble of 20 years ago. I think a lot of people think there's scope in the estate agency space for an online-only agent. So when one goes with a lot of publicity and a lot of backing behind it, it then gets a lot of support, and you have this virtuous cycle for them that they are just improving and improving. And you could see, I mean, the Countrywide Group, which is now owned by Connells. So for people who don't know the ins and outs of the industry, the Countrywide Group, people might recognise the name Countrywide in Scotland, but that actually is just coincidence that there's a brand in Scotland that's the same name as the parent company. They also owned Slater, Hogg and Howison, and at the peak of the market they had 1,000 branches UK wide, with I think 14 or 16 different brand names throughout the whole of the UK. And they were the predominant and leading estate agency brand in the UK for many years. So it was the Countrywide Group. They bought the Bradford and Bingley Group, so the brand names that people would recognise in Scotland, Countrywide and Slater Hogg with the Bradford and Bingley Group, and they became really large. Market crashed, and of course the challenge when the market crashed and sales fell through the floor in 2008 is your biggest cost in estate agencies, people and premises. And so you can get rid of some people, but if you get rid of all your people, you can't work. And you can't, and that is a brand that was built around high street locations and being the local experts. And so when all of that was happening, and then Purplebricks launches, then the smart money, for want of a better way of putting it, sees Purplebricks as the future, because they've not got that tie of the branch network, and they've got a fairly flexible people network. So they think that will work. But it was really just in a readjustment in the marketplace where those brands like the Countrywide Group got to grasp how to operate in a lower volume market. Scottish housing market at the peak of 2007, there was about 160,000 properties a year were transacting in Scotland, and then in 2008, 2009, it was down at 60,000. So you can see it massively decimated, and that would be replicated throughout the UK. So this massive adjustment had to happen. Countrywide had a real difficulty doing it because they'd had a hedge fund buy them out beforehand, which had leveraged up them debt, so they had peculiar circumstances. They've eventually been bought by Connells, which is Alan Harris. I do find it funny when you go down a high street and your choices are Alan Harris, Connells, Countrywide, Connells, Slater Hogg, Connells, but they probably aren't aware of that. But they've all managed, that group and other high street premises have now managed to work out how to balance out the high street presence with an online presence. They've managed to work out how to do it probably better than lots of retailers in the general market have done. And that's then created a problem for Purplebricks, because the issue there is, unless you spend an absolute fortune on advertising, if you've not got that local presence, people forget you exist. So you continually have to be chucking money at that marketing for people to know that Purplebricks is still there, because they're still seeing the high street brands that are out there. And that massively impacts it.
Stephen, I'll question to you, right? Obviously, if you did a flip and all that, would you be tempted by a fixed fee estate agent? I mean, obviously, Purplebricks, their model was you pay £850 and we'll sell your house, right? But you pay that up front. So would you go down that route? And because, like, you know, I know what my thoughts are.
Yeah, I never have. I never did. Even when they were riding their heyday, it was always a local estate agent that I had a relationship with, and you know, the person in the high street, the local expert, the one that's got people in an office that they can,
But you want the motivation to be there, don't you? Obviously, like if you're paying a fixed fee up front before the property is even on the market, what's the issue there?
You see, this is where my being an old-fashioned estate agent comes into play.
Let you rip, Brian.
I never saw. I knew people who went into Purplebricks, and there was
decent
almost
people, probably plenty of
decent people, and it was almost like that hybrid model of a bit like the way the American system works, where you've got this realtor who runs around and
Century 21 at the time.
And they worked on that. And Remax, when they started, they tried to bring in the American model and then realised you can't come in and change the way the Scottish market operates. And yes, things have changed in my day. Sound like some born old fart here in my day. But in my day, it was a lot easier to be a salesperson because when you phoned people, they didn't have number recognition on their phone. They phoned you up with a house number and a work number, and you phoned them and they answered the phone, and you could more easily persuade someone who didn't want a house. You could persuade them that actually this house was for them, and you could do proper salesmanship on it. And that's gone a wee bit, but I still think local presence matters. Local market matters. I always used to get frustrated with surveyors in that a local estate agent will really know there's a wee pocket here which is not like the neighbouring properties, but see the type of person who might buy here, they will buy that type of house that's just a mile down the road. And so actually when you're looking at valuing that type of house, a local agent knows it's the same type of buyer who buys over there. And
I had a similar thing, actually, a conversation with someone just recently, which hit the nail on the head. That there's an auction company that lists properties in Aberdeen, and someone has phoned me and says, "Look, I've got this valuation, and it's just making no sense." I says, "Where's the surveyor from? Like, just look at it." Yeah, DM Hall in Glasgow. The hell do they know about property in Aberdeen? Like, and like you say, it's the pockets in every street in every area is so different from local knowledge that it's so important.
Which then, I know it's probably not on your agenda, but it feeds into why I think home reports should be torn up and started again. I have no time for home reports for a variety of reasons, but one of them was the way the market used to be. You would have local surveyors as much as local estate agents, and the local surveyors again would speak to local estate agents to find out, because when a market starts to peak, it accelerates really quickly and the record of sales takes a few months to pass through. So you would have local surveyors phone an estate agent to find out what's happening right now in your marketplace, because somebody's just asked me to go and value this house because they're thinking of buying it right now, not what the market was like driving, looking in my rear view mirror. And that type of information and that knowledge of your local market is invaluable. And I think that's the biggest challenge. And of course then in traditional estate agents, you've got that branch network that people pop into, and you've got that network of staff that if the key person's not in, you've got people in an office who can answer the queries, which is where all this online virtual agency starts to struggle.
Yeah, no, I agree.
I think they're still keeping their name, Purplebricks. I think the brand will still be out there, but I'll be interested to see what happens. From a lettings point of view, because I'm a letting agent, I was quite interested to see what's going to happen with their lettings portfolio. So they've sold that to Lomond Group, which are like massive all over the country. But I mean, I had to laugh because they did do lettings, and obviously they did lettings because they've sold their portfolio, but they messed it up big time, basically. They weren't, I think it was like you talked about earlier on, they were probably just adopting all the systems that they had set up down in England, and obviously we've got a very different system up in Scotland.
And that's key for people to be aware of sometimes with national companies. So I've worked for a national company, and when the market's great, they leave Scotland to itself because they don't really get it. And so you end up getting more holidays and things like that as well, because they don't quite understand the way the holiday system works. But when the market crashed 2008-9, they had no time for a handful of branches up here wanting to operate differently from the rest of the UK. And a phrase that I used to hear at meetings was, "We will tartanise that." It used to really rile me, because it was basically, we can't be bothered getting things to properly fit with the way Scotland operates. So we'll just try and smash a square peg until it fits into a round
Does
hole.
they send you up one of those CUV Jimmy hats?
I just used to hate it. Everything about it.
Right, so a lot important to note. Obviously, there could be a lot of redundancies, and obviously, thoughts go out to people who could be losing their jobs there. So, although we have a discussion about this, there will be people affected, but I'm sure the good people will come through the other end out of this. Going on to our next news report, which is the headline is mortgage rates rise after inflation surprise. So you love this chat about interest rates, don't you? I keep you updated every month.
Yeah, I mean, I felt the pinch this month. There was mortgage products, putting through on buy-to-let properties that were up for their fixed term is up, and they were the banks started pulling the products. And they gave you a timeline. They were saying like by midday tomorrow, these are gone if you don't get the application in. And
the reason for this is because inflation figures came out, and although they have dropped to 8.7%. Actually, when you look at it, that was a lot higher than expected, I think, was what the markets were predicting. I think we're coming from 10.2% or 10.1%. So on the face of it, you think, what's the problem here? But obviously, when the Bank of England's target figure is 2%, we're still a long, long way off. And a lot of economists predicting that, inflation is going to start getting sticky around the 5-6% because of food costs, fuel, energy, all the rest of it. So, Brian, looking at this, mortgage rates, I think the stat is the Nationwide came out with an increase of up to 0.4%, an increase in some of their products. Stephen, you were saying a lot of the other lenders pulled their products and reevaluating. I guess when you look at it though, we had that big shock at the mini budget when Liz Truss came out with all that news, and then that's when we had the huge spike there, and the markets were pricing in that. They were coming down ever since, but now they've kind of gone back up again, but maybe not so bad on the grand scale of things.
No, again, on the grand scheme of things, you're right. The challenge in September, October was they were trying to second guess where everything was going to go, and everything was going crazy, so they were over budgeting, for want of a better way of putting it, rises into the future, and so the rates leapt up because they didn't want to be caught out with things going crazy. We do have an issue, without getting my economist head on, we do have an issue with the Bank of England's job is to keep inflation at around 2%, but they've only got one tool to deal with that, and that's interest rates, because usually one of the drivers of inflation is too much money and people spending too much money. This is a supply-led inflation, so there's a lot of debate about interest rates shouldn't be going up at all. The interesting thing, and you're right, there was a lot of talk that inflation might be down to 3-4% by the end of the year. Now it's about 5% because food inflation is running at about 19%. Yeah. So that's where the challenge is, and they can't get it down enough. However, the Bank of England put up base rates by 0.25%. The average across products of a fixed rate mortgage only went up 0.02%, so they didn't go up at the same rate that the Bank of England did.
Must be for general residential market.
Yes, for the general residential market, and actually 3 and 5 year products. You can get a 5-year product for slightly less than you can get a 2-year product, which is an indication that the lenders think we have gone through the worst of it. Yes, there was predictions that the rate rises had stopped, and so the most recent one has been a wee bit of an irritation. But the general movement and expectation of where things are going are that we're levelling off. I don't think we'll return. You've got to remember where we were at interest rates at around about 1%. We're just crazy, uneconomically low, and we're never going to stay at that level, and that the norm that we might need to expect is to revert back to interest rates between that 3 and 5% band. But that's still a long way away from where the norm used to be, even as recently as 15, 20 years ago. So I think you just have to adjust expectations.
I think the biggest thing for me is it'll be the people that are on fixed terms, particularly with their own residential house. If they've, I think mine is fixed at 1.4 for another 4 years, but when you come off that rate, people are going to be getting a shock. And if they've already stretched themselves financially and the squeeze is coming, what does the end of a fixed rate term on their own house do for them financially?
Well, I was trying to speak to, so we do property factoring as well as lettings and other stuff, and I was trying to speak to someone who desperately wants a building to get a big repair done on it, and they were frustrated that some of their neighbours were saying they couldn't afford it. And I was trying to explain to them what can't afford means, and so one of the bits I did was I showed if someone had a 135 grand mortgage, so maybe just a first time buyer who'd got it 2 years ago and might have been paying, I think the rate I worked out, if they had a 135 grand mortgage 2 years ago, they'd have been paying £520 a month, and they'll be coming to the end. They might be coming to the end of that 2 year fixed rate and going to 840. So I was trying to demonstrate that's a massive leap, 520 to 840 in monthly payments when their mortgage size hasn't changed. Because this person was saying, "Oh, sure, they can just go to their lender and get an extra 10 grand on their mortgage. How much is that going to cost them?" And so I was trying to demonstrate that it wasn't just the extra 10 grand, it was the extra 10 grand in the context of the mortgage might already be going up 300 quid.
Yeah.
And that's a young first time buyer, £300 a month.
I think that's what worries me is it's not the mortgage rate jumping, it's everything else before it. The cost of living, the food, energy, fuel, everything's been squeezed before it. If you're coming to the fixed, the end of your fixed rate this year or next year, you're already squeezed hard in an extra 300, 400, 500 quid, 600 quid. I mean, I've saw some examples recently of, they've already stretched themselves quite high on a 230 grand mortgage at £1,000. That's almost doubling. Like, that's a tricky position that people have put themselves in by over leveraging or overstretching, and now everything's been getting squeezed.
Which gets back to that Skipton Building Society.
Because one of the problems that we've got as landlords, of course, is that a couple of my 5 year fixes have come to an end here that I've had tenants in for a long term. So these are long term tenancies. And of course, my traditional view is, great tenants, long term, don't put the rents up. And obviously now I've got the new mortgage rates come in, mortgage product switch, and I'm now just scraping by on a lot of them, and I'm stuck. I can only put the rent up 3% or 6% if I obviously apply to the rent office. But I mean, in terms of figures, a property that was generating £300 a month cash flow could be about £80 or £90 a month now. Do you know what I mean? £100 a month. So that's for when you look at it like that as an investment, I'd be better off having my money in the bank for a 5% interest.
Well, you say that.
You're not factoring in capital appreciation.
Yeah, you're chucking your capital.
I'm just trying to get an argument going here. I'm just trying to noise it up. Do you know what I mean? You're absolutely right. The capital growth is...
No, but it's actually really important to emphasise to people, because people forget.
Well, I think because it would been so low historically for the last year, everyone's now thinking cash flow from your property investment. Yeah. But no, years ago, people just covered the cost of their mortgage, and the rent covered the mortgage, and it was more for the capital appreciation. Well, when we go to sell it or the mortgage is paid off, we've got probably worth a hell of a lot more.
Yeah, and you hear a lot of chat, and obviously, I've had some direct interaction with politicians about the rent rise cap that they put on in place, and you hear a lot of chat when the rent rise stuff came out of landlords are going to leave the sector for the very point you've made, and you say, are you? Are you really going to sell that and pay the capital gains tax that you're going to have to pay for the capital growth that you've had in the property? And what are you going to do with that? I always use £100,000 because it's easier for me to do mental calculations. You take that £100,000 that you've then made and you've already just paid tax on it because you did the capital gain tax, and you go and stick it in the building society, and you get a whoop-de-doo rate of 2%, 2.5%, because although interest rates are going up, you're still not getting fantastic rates on investments. Yes, if you have fixed.
Although I was saying earlier on, I did find one at 5%. I was saying to the guys earlier on, a fixed rate for a year.
Yeah, so you get fixed for 1 year at 5%, right? So you're £100,000, but you've already just paid tax on that to lose money. You've also paid your estate agent to lose money on that £100,000, and then you go and stick it in for 5%. Well, actually, despite everything you've whinged about your rentals and the direction of travel, you were at least getting 5% return on your investment on your rental. Plus,
you've not lost the money.
You're not getting your capital growth now because you're getting 5% in 1 year. Well, that £100,000 in property is getting 5% on your net, on your rental yield still, and you're getting your capital growth that you still factor
Love
in.
it, and that's why I like to play devil's advocate, because I like to get both arguments. By the way, I'm still invested long term for property, and I love property, and I'll still continue.
But it's important people don't forget that, because people can get carried away in the emotion of it.
But do you know what? I kind of think it's doing the right thing. I've said this before. I think it's getting rid of the amateur investors, the accidental landlords, the ones that have got a handful of properties in their own name, don't quite keep up this date with the standards and the repairs and how they should be, they're getting so pissed off. That's going, no, do you know what? That's it. I'm out.
Penny pinchers, and
they're going to get rid of it. And I think it's a good thing for the industry.
If you've got a well balanced portfolio as well, you know, like I've got other ones that I've managed to change the tenancy and put the rent up, you know, £300-400. Do you know what I mean? So like it all balances itself out if you've got a decent sized portfolio. Moving on to our next news article, spike in mortgage arrears and homes being repossessed as interest rates soar. Right, so this is repossessions are on the rise. Now, again, probably important to say that these figures will be taken from UK wide, you know, so it's very difficult to get a lot of times Scottish figures. Yeah. So you know, it's interesting because this is a general trends, and the figure is there was a 50% increase in the number of homeowner mortgage properties being repossessed in the first quarter of 2023 compared with the previous 3 months. This was by UK Finance. Some 750 homeowner mortgage properties were taken into possession in the first quarter of 2023. So a 50% increase in repossessions there. That's quite a bit. Do you think the figures are skewed at all from like, do you think there's been a
COVID backlog maybe that they couldn't get them through the estate or
that's what I was
thinking. Well, there'll be a number of factors. I mean, one, it's from an incredibly low base. The number has doubled to 750 is what you just said there. So it's from a really, really low base that they're coming from. Not surprising that it's the first quarter of this year because it was September, October that we saw the massive leap in interest rates. So these might be people who were already on a variable rate, hadn't really paid attention to what was happening, and they've probably been hit by all sides. They'll have been hit by the energy prices going up. And, you know, having been in a estate agency, I've been in that very unfortunate position that you go out to a repossessed property. And I remember the very first one I went into, there's just this pile of letters in the corner that the sheriff officers had piled up, all from the bank. And I shouldn't have opened them, but I opened one or two, and they were all saying the same thing. Please, please, please contact us. Please, please, please contact us. So I think what you find in a lot of those things, a lot of times, it's the volume of debt that person is experiencing just becomes overwhelming, and then they switch off and just ignore everything. So it's probably been a culmination of, for those types of people, everything coming in at once at the end of last year.
It'll take time as well. I mean, obviously lenders can't just go in and like repossess a property like that. There's a whole process they need to go through, so that will take some time to come through as well. Sorry, another stat here as well. Out of those 750, 410 were buy-to-let mortgage properties. So
still a very low number, like Brian touched on there, for the whole of the UK. It's a low number. If you base that in low, it's fine. You can see an increase of 28% on it, but
I think it's just a trend. Obviously, I can see it obviously will continue to rise.
Yeah, I suppose what they're trying to illustrate is a concern. We're seeing interest rates go up. As anybody listening to this will know, if they're an investor in property, investors' interest rates are higher than homeowners' interest rates, so it's not surprising that it's buy to let. And then, of course, there is legislation coming in England as well as we're seeing in Scotland that is being more onerous on landlords. So I suppose that what they're showing is there's now starting to be that landlord, getting back to your point about the landlords who they're not sophisticated landlords. They're probably the ones who are getting this hit, that they can't manage what they're doing properly anyway, and they'll be the ones that'll be the first ones to go.
Yeah, I mean, I guess like you might think to yourself, well, you know, if you're in mortgage arrears, you know, and obviously you've had the property for a couple of years, you think to yourself, well, surely, you know, you could just sell up, and obviously you'd probably, you know, do all right. But in Scotland at the moment, it's not as easy as that. You know, if the tenant decides to sit tight, you know, you can.
But again, getting back to your point about lenders, you would think in those circumstances, if somebody turned around and said, look, I'm struggling to pay for this, I'm in a real difficulty, but the law's stopping me getting rid of the tenant. A lender, you would think, would rather work with that person than then just say, no, we're pulling the plug and you're out.
That's a good point. Yep. Moving on, the headline is that thousands of landlords sell up to avoid net zero rules as buy-to-let no longer viable. So where did this come from? So somebody's come out with this ridiculous statement. Buy-to-let's no longer viable. You love all these negative headlines, don't you? So basically...
It's just to do with EPCs?
This is to do with EPCs. So more than 65,000 rental properties went up for sale in the first 3 months of the year. New instruction data from estate agents showed of these, some 36,460 had low energy efficiency with an EPC ratings of D or less, according to market analysis 20C, which collates figures from property firms across the country. So it's been a long day. I'm burning up if you're struggling to read this.
It's the first warm week of the year in Scotland, so we're roasting in here.
It's absolutely boiling. So basically the general consensus is that landlords are starting to sell due to these upcoming EPC restrictions, possibly. You know, is this a thing that you've had conversations about with other landlords, Brian?
I've not. I don't know about you. I've not specifically had any landlords say, I can't do this. Again, I mentioned home reports earlier. EPCs are pretty much not fit for purpose. You know, I don't know how many people listening to this have read one of a first floor tenement that recommends putting in loft insulation, for example. I mean, in my own home, so I live in a sandstone semi-detached house, and for something I was going to be doing on the radio, we were going to be talking about EPCs, and I thought, I'm going to look into, I don't know what the energy rating is in my home, but I have a good idea it'll be similar to, there was a house I'd sold diagonally across the road 2 years earlier. I thought it'll be similar to him. And I looked at their EPC rating and they were D and just below the D. And to get into C, it could only, the recommend, you know, and if anyone's read an EPC, it gives recommendations at the end as to what you could do to improve the energy rating of your home. And my neighbours could only just scrape into C. So mine would have been the same. And to just scrape into C would have, the things you needed to do would have cost £14,000. And it was things like either external or internal cladding in every room. Well, I live in a sandstone house that one street away is where the conservation area starts. So external cladding's not in. So internal cladding is going to be about, 20 centimetres thick on every wall. So it's going to reduce the size of my wall. I'd have to rip out the cornicing to be able to get it all the way up to the ceiling and bring it in. And then the cost of 14 grand would have resulted in £100 a year savings. Well, I look at that and I think, okay, there must be a correlation between financial cost and energy cost and carbon cost in terms of the making all that material. So you would think the 14,000, the high cost of making it in terms of pound, shillings and pence would be replicated in the high cost of making it in terms of the carbon cost, and the low amount of savings into pound, shilling and pence would equate across to the low amount of carbon savings. So basically, if I ruin my house, in 200 years' time, I'll have got equilibrium in saving the planet. Whoop-de-doo. I don't really think that's worth it.
But it is coming.
Yeah, I know it's coming, and that's why, for me, you can't bring it in without ripping up EPCs and redoing them, because patently, that is a nonsense. Patently saying to someone, it's 14 grand, and it was only just in, it was only moving marginally 3 or 4 points from the top end of a D to the bottom end of a C, and then it wasn't going to be getting any better. And so the carbon footprint of trying to make those savings, of the lorries that are going to be making the delivery of the materials to my house to put the internal cladding on, would be greater than any saving that I could make. And I say that as someone who's well aware of the fact. I'll trot out one of my other interesting stats of the day. The west of Scotland, where I live, the winters are 60% wetter than 50 years ago. That is an amazing transformation to our climate. So I say that, and I say that as someone who's 52, so it's really resonant that basically the whole of my lifetime has seen the west of Scotland get 60% wetter in the winter. So patently something needs to be done. But don't do a tick box exercise. Do something that actually makes a difference, or don't do it at all. That would be my point. And EPCs are just not fit for purpose.
Yeah, I think that until basically the government, because they keep knocking it back as well, right? Because until, like, I'm probably sitting on a few that are D's and possibly an E actually. And until they actually come out with a clear objective, I mean, I know they have said 2025 and 2028, but really until it happens, I'm like, I'm not going to go out and spend 10 grand on the property. Do you know what I mean? So it needs to be.
Scotland's littered with pre-1919 properties. You know, our big cities are full of pre-1919 properties with half-metre thick sandstone.
Session case windows.
All these issues, and a lot of them in conservation areas and in listed buildings where the changing the windows is going to be a major problem for them. So to then come out with this blanket, or it needs to be C for no other reason, and that it makes our life easier to just have a generic exercise of everything's got to be a C. You know, again,
it needs to have a system overhaul.
There's been an exercise they've been doing just now to try and see if they can make tenements C or carbon neutral buildings.
Yeah.
And the only way to do it was basically to take the building right down to the only thing left standing was that half-metre thick sandstone, and then rebuild the tenement. Well, taking into consideration that just to keep the buildings wind and watertight, there was a survey done of Glasgow's housing stock just before COVID, and it'll cost £1.9 billion across the tenemental stock of Glasgow, just to make it wind and watertight. Never mind to make it a C rating thing. So
brilliant. Good. No, it's good to get your take on that for sure. Moving on to the house prices. So obviously we take our data from the ONS, which obviously is the Registry of Scotland.
Registers
of Scotland, which is the actual recorded house prices, because there's like 5 or 6 different house price indexes. You can Rightmove, Zoopla, there's another Nationwide, Halifax, yeah. And everywhere you look, they're all telling you different things. So we've decided on the Scottish Property Podcast, we're only going to talk about the official recorded sales. The problem with that is obviously it's a lagging indicator, because as you rightly said, Brian, the house prices that sold last, what if this is March's data, you know, a lot of those houses could have been sold like
December,
it's a winter. It's telling you what the market was like in the winter, in November, December, January.
Exactly. But if you look at the graph on the website, there is showing a downtrend, obviously, from the peak of the market, which was like April 2022 in Scotland. And it has been on a gradual decline of increases, you know. So we started off like 16%. We're now down at 3%. So the data's come out. House prices are still rising compared to the data over the last 12 months, still rising at 3%, albeit a lot slower. So that energy has come out of the market. Average price of property in Scotland is 184,877. The monthly change of a property in Scotland was 0.7% increase. And if we look at some of the quotes here, average house prices in Scotland increased by 3% in the last 12 months to March 2023. This was up from 2.8% the 12 months to February 2023. So there is like a bit of a bounce. Things were kind of on the down in the last few months. We've noticed a bit of a bounce there, back up. So things looking a bit more positive. Brian, what's your thoughts, like things around Glasgow? Obviously, you've got an estate agency as well. The market's still pretty strong.
The market's strong, and what I don't know if you guys thought this as well. What I thought was happening in sort of October, November, December time in particular was volatility in the market, because what people were hearing about what was about to happen to the market was a different message every day. And so what that does is it makes people who don't have to move, it makes them pull out of the market and say, I'm just going to sit tight until everything settles down. But of course, that can end up being a self-fulfilling prophecy of a downward trend in the market, because if everybody says, I'm going to sit tight, then it drives it down. But eventually people need to move. And the key time that people want to be moving is March, April, May, June, because of schools in general. That's what drives things forward. And as I kept saying to people during the burst of activity that happened immediately post-COVID, when they were saying, oh, look at the house prices, the 16% that you mentioned. Yeah. I've got friends who are looking at Edinburgh. Oh, these prices can't be sustained. And I said, well, it depends what snapshot you're taking of the market. Exactly. If you take an 18-month, 2-year snapshot in the market, then the prices are rocketing. Mm-hmm. if you then widen that snapshot back and go back to, and the crash of 2008 was such an enormous event in the housing market that you always have to reference that when you're looking at everything. And what happened in Scotland was, third weekend in March 2008, our market literally fell off a cliff. I mean, I was working in a estate agency where the first week in March our sales figures were normal, second week in March sales figures were normal, third week in March they were worse than the week of Christmas. I mean, that's how dramatic it was. And then large chunks of the rest of the UK, and particularly London and the South East, they'd recovered all their losses within 2 years. By 2010, they had recovered all the losses of the 2008 crash, and then it started going back up at reasonable rates, at 4-5%. We didn't. We took from March 2008 to March 2018 to get back to the average house price in Scotland. And so if you look at it in that much wider context, then all we've been doing for the last 3 years is actually just playing catch up on what everybody else has been doing for the last 10 years. Yeah. And so it's not unreasonable. So it's not then unreasonable that catch-up levels off a wee bit, because what happened in COVID is actually a lot of cash get pumped into society and pumped into business. You know, the COVID bounce-back loans that, yes, people were supposed to be playing to do with their business, but it did mean that there was additional cash pumped into the system. And so that's not a surprise. That would then just give it's like when you see in the film when the two things go in the chest and the body jolts, that gave a jolt to the Scottish housing market, which was starting to recover after the 10 years of the wilderness, effectively. It just gave it a massive jolt, leapt it up. So it's not unreasonable that things then settle down to 3-4% rises.
And I always like to pick out the two markets that we both invest in. So obviously Stephen's up in Aberdeen, they're showing a negative 6.9% difference.
Great growth
over the 12 months. But interestingly, Glasgow has dropped into negative. This is the first time I've seen a negative here. This is panicking me a wee bit. Nah, it's not. So City of Glasgow, we're actually... I've lost it now. City of Glasgow, minus 0.7%. That's the first time I've seen that as a negative. So obviously things starting to have an impact there. Brian, give us your prediction, mate, for to finish the year off in 2023. Where do you see prices going? Give us a figure, because we're asking all our guests.
Well, I would say that you'll find that by the end of the year, the average house price in Scotland will have grown about 3% through 2023.
Still up over the last 12 months from the end of the year.
Aberdeen, there's no saving Aberdeen. Honestly, Aberdeen kept going. After 2008, Aberdeen kept going for 2-3 years, but then has not done anything since.
Cut that bit out and send it to Chris Minchin, he'll love that. We've got like an agent friend up there.
But one other thing I would say, really interesting stat to chuck in, that was out in the last week that you've not got. The property portals are reporting that the quickest selling types of areas are towns and cities.
Right.
Because people spent COVID looking for gardens and suburban.
Race for space.
And in the last couple of months, what we've done is we've now started reverting back to what we are, which we are city dwellers. So that, keep an eye out on your Glasgow prices, that you might start to see prices going back up.
Interesting.
Look out for that. Lastly, Brian, before we dye the heat in here, right, we'll just wrap up with the rents. So there was some data produced by Hampton's estate agents, and they're predominantly English, but they own, or they've part of the group, like you said, that own Countrywide, Slater Hogg, all the rest of it. They're collecting rental data in from Scotland, comparing it against the rest of the UK. And if we look at their rental data, rents in Scotland up 12.8% over the last 12 months to April. And see if you can compare that with all the other regions in the UK. It's actually second highest, out with London. So London's top spot, 17.2%. But if we could take that out of the equation, rents in Scotland going up the highest out of all, even the north of England and Manchester and all that. So, what does that tell us about the Scottish Government's intervention about keeping rents down.
It hasn't worked. It's the simplest thing. I mean, very, very quickly, because what it does, these statistics are measured on new rents.
New rents.
And so what that does is it makes any landlord who's a portfolio landlord recoup the inability to put his rents up on sitting tenants with a property that's just become vacant. I'm going to whack my rent up on that for two reasons. One, to get my money back on the one that I can't put the rent up, and two, because I don't know if I'll ever be able to put or when I'll be able to put the rent up on this property. So they put the rents up. So it's that, it tells you that doesn't work. Secondly, it tells you there's uncertainty in the Scottish economy, because rental markets have greater demand when there's uncertainty in the wider job economy, because people are reluctant to take on a mortgage. And then thirdly, it just points to how few houses we have built in Scotland for the last 20 years, particularly affordable housing. And that is the biggest reason why rents are going up. And the Scottish Government have decided to turn around to the private sector and say, you've got to swallow it because of our inability for the last 20 years to build affordable housing.
100%. That's a whole other podcast in itself. But
that also swings back to the first article on the skipped in mortgages.
Yep.
Available for London and Scotland. So those tie in very nicely of what the highest rental demand is.
Yeah, well, they're probably looking at that market and going, where is the need? You know, where are people going to take us up in these mortgage products? You know, what are the markets that are really heavily impacted? So absolutely. Listen, Brian, it's been an absolute brilliant episode. Thanks for all your market insights and your knowledge. First
class. Boring, interesting stats.
First class as ever. We'd be delighted to have you back on if you'll come back, and we'll make sure we get the aircon on next time as well.
Cheers.
Bye. Thank you very much.
Thank you.